I think one of the important lessons behavioral economics teaches us is to recognize our limitations and to recognize that there are many imperfections in, for example, belief formation, and to be modest about the capacity to forecast the future. My name is Yue Ma. I'm an assistant professor at the University of Chicago Booth School of Business. I'm interested in studying expectations formation, and by expectations, we mean the beliefs or views that people have about the potential realizations of uncertain outcomes in the future. For example, when savers and investors invest in financial markets, they need to think about the future cash flows or returns of the securities they want to buy. When firms decide what projects to take, they need to think about future customer demand and potential competition. So these views that people need for decision making, for informing their decision making about future outcomes. And so in recent years, there's a lot of interest in understanding the empirical features of expectations formation. Expectations are a central issue in economic decision making and research for a long time, but for the past few decades, the benchmark in research is generally rational expectations, which postulate that people can process information frictionlessly, they know the right set of information to use, and they can form rational, unbiased beliefs about the future. So that has been very useful as a theoretical construct, but not necessarily an empirical statement. And so what my research is focusing on is to understand the empirical features of expectations, utilizing a large set of expectations data from many domains, for example, beliefs about returns in financial markets, about bond yields, stock returns, credit spreads, or returns to firms, investments, firms' future earnings, and how that shape their investment decisions, beliefs about macroeconomic outcomes like GDP growth, inflation, as well as in some very simple controlled settings like controlled experiments. So the first part, I think, is important to understand the consistent structure in the empirical features of expectations across different settings. And the second part is, once we know some of the structures, what are the implications of these structures in expectations? So for the first part, I think over the years, and by looking at many different domains in my own work, in learning about other people's work, one of the features that does stand out is people tend to over-extrapolate. And in particular, that means that people think past trends or shocks are likely to continue more than they actually do. For example, when past earnings or recent earnings are high, firms have a tendency to think that future earnings will be higher than what future earnings actually are, and vice versa. And this generalizes to many different settings in financial markets and corporate investments, in simple controlled experiments, and macroeconomic expectations as well. And these features are particularly pronounced when the actual process has low persistence. And the second part is to explore then what are the potential implications of this important feature, which is over-extrapolation of recent trends and shocks. This has promise for understanding, for example, fluctuations in asset prices, booms and bubbles in stock markets, and potentially help us understand credit cycles, investment cycles, cycles in house prices as well. So this is a very lively body of work that I've been doing and many other people are doing, and hopefully we will come up with a unified understanding of the structure of expectations and the settings where these persistent and pervasive features of expectations are most important. A lot of the intellectual explorations in many ways date back to the origin of behavioral finance in the 70s and 80s, when, for example, Shiller and Dupont and Thaler look at the stock markets, saw the large fluctuations in stock markets, and hypothesized to some extent that part of this could be driven by people overreacting to news. They think that either past returns will persist more than they actually do, or the news are more informative than it actually is. And so over the years, there's a lot of advancement in both documenting systematic biases and beliefs in the data, understanding that their pervasiveness, and then connecting it to explaining these puzzles that originally pointed people in this direction. Now we understand some about the particular settings where biases are most important. So the conditions are first, in cases where the underlying process is not very persistent. That's the case in stock markets. That's often the case in some of the outcomes that we care about in credit cycles and investment cycles as well. Earnings are not very persistent, and firms tend to think that they are more persistent than they actually are. And I think generally from our work, we learned that biases and expectations tend to have a bigger impact when there's more volatility. If the environment is very stable, then there's not much that people can get wrong, but oftentimes we live in very uncertain environments. There are many fluctuations all the time, and those open up for the possibility of large errors. So I think we know that these extrapolative biases tend to have larger impact when there is a new wave of things. There's a lot of potential new shocks. In terms of fully explaining, for example, understanding how much of business cycle tie back to expectations, how much of the macroeconomic fluctuations tie back to expectations, I think that's a very important issue that we're still working on, fleshing out the quantitative analysis, because one, it depends on the model that you write. The quantitative assessment is much more model dependent. And second, there is a lot of challenges in specifying the particular setting, and the quantitative results that you get would also depend on how you specify the setting, the types of other frictions like financial frictions that you embed. So I think it's a very lively area of research, and there's a lot of more work that we're in the process of doing and hope to have a better understanding in the next few years. For me, I am an empiricist, and I think an important mission of empiricist is to understand the connection between theory and practice. And so my tendency is to look around in the world to understand how things actually work in practice and how they relate to or may differ from theoretical benchmarks. I don't think as an empiricist we are bound by some conventional wisdom from theory. We want to understand the essence of theory, and we want to understand what happens in practice, and what elements of the traditional framework is right and what elements may be modified to better understand reality. So if you start from an empirical perspective, then there is a lot of empirical evidence that points to imperfections and expectations. I started by looking at, for example, firms' expectations of future earnings. There's a wonderful set of data compiled by John Graham and Cam Harvey at Duke University, which is now more than 20 years of surveys of CFOs on a quarterly basis, CFOs of major firms in the US, S&P 500 firms. And that data set provides a very rich set of resources to understand beliefs that firms have about the future and how they relate to investment opportunities. And when you start looking at it, you do find that it's a very robust feature that firms tend to think current or recent earnings tend to persist more than they actually do. And at the same time, there are other researchers, for example, Andre Schleifer and Robin Greenwood at Harvard, where they were looking at expectations of stock returns and find that they're typically the opposite of what a rational model would predict. Rational models generally predict that during times of stock market booms, then the expected returns going forward should be low because current prices are high. Whereas when you look at beliefs that they assembled from investor surveys, when you actually ask investors during stock market booms, they would say they expect stock returns to go up. So those are very direct evidence that points to systematic deviations from rational expectations. I am sure if you ask your friends during a stock market boom whether they think the future returns will be high or low, people generally say they'll be high. So those are things that we encounter a lot in practice, in reality, in data. And I think those are things that generally would point you to rethink the conventional wisdom. And in this process, I think it's extremely important to put structure on the data. The conventional wisdom, for example, rational expectations, may not be a good empirical description. And then the question is, what is a good empirical description across different domains that is consistent, and what is the origin of that? That opens many questions, of course, for researchers to explore. And I think ultimately the empirical orientation is very important for guiding me to work on what I work on. So in terms of policy, one commonly brought up idea recognizing the limitations for both the markets and policymakers to forecast the future is to build financial structures that are robust to unexpected large declines in asset prices or to recessions. For example, the stress test idea that came out of the crisis to, regardless of the belief, to make sure that financial institutions, especially systematically important financial institutions, can withstand big negative shocks, is one of the very important developments in financial regulation and could be very helpful in a world where we don't necessarily know what's going to happen next. Even today, for example, when you look at the capital markets, asset prices have been at very high level for quite a while, and there are investors who are very cautious, but so far we haven't seen a major decline in asset prices. That may still come in the future. Nobody can know for sure. So in this type of very uncertain environment, I think ideas like stress test would be very helpful. On the note of unification, there is work that I've been involved in and many other people have been involved in trying to understand whether the beliefs and biases and beliefs across different domains are fundamentally connected. For example, one theme that connects things is stereotypes. There are stereotypes about people's abilities and oftentimes exaggerating certain features. For example, exaggerating the amount of Irish people who have red hair, for example, exaggerating the ability of certain groups in certain things, for example, Asian in math and so on. There is some potential that exaggerating these features in the characteristics of certain groups and exaggerating the possibility of future stock returns being high, maybe there's something that is connected. For example, it's much easier for us to think about things that come to mind more easily. There's a body of work in psychology on memory and how memory can potentially shape beliefs. For example, when I mentioned egg and tomato, it's much easier for you to think about bread and butter as opposed to car and lines or things that are not very related. In the same spirit, when you see past high returns, you're more likely to think about future high returns. And potentially in the context of stereotypes, the features that are commonly associated come to mind more easily if you've been exposed to a lot of association of Irish with red hair or Asian with being good at math, then these two, you may exaggerate their relevance. So some of these tendencies can be used by social groups for certain purposes, strategically to perpetuate some norms. In the context of gender, for example, if there are certain social groups who are interested in encouraging girls to stay at home and have kids, then they can perpetuate stereotypes that girls are not good at work or good at academics, good at professional skills. And when they build these very strong associations and embed these associations in people, then people can have biased beliefs about girls' ability in professional settings that lead to a society-wide, widespread stereotype beliefs that are biased. So I think it is a very interesting question ultimately to understand some of the deeper foundations in the formation of biased beliefs, the role of, for example, associative memory. And those are very exciting interdisciplinary areas where we can learn a lot from psychologists, from neurobiologists, and ultimately understand some of the very foundational questions in belief formation, in financial markets, and in other areas of social science and economics and finance.